Okay, hello everyone, and welcome to Econoday Unplugged. Hope 2017 has started on a profitable note, but if not, don't worry because there's still another 51 weeks of the year to get it right. I'm Jeremy Hawkins, Econoday's economist here in London. Anne is still trying to shake off a particularly virulent cold at the moment, but happily, our US guru Mark Pender is here as usual to chew the economic fat with me. So, Mark, talking of fat, just how lean was last week's US employment report?
Lean. Well, the employment growth is slowing, which is understandable given how strong it's been in the past. But it was still a solid report, and it had a big uptick in wages, wage pressure, the second in 3 months. And it's taken the year-on-year rate to 2.9% for wage growth, which is just about where the 3% barrier, which ends up spilling in or is considered to spill into overall inflation. We're at a possible wage inflation flashpoint even before the new policies of the administration can be introduced or take effect. Where we will find these people to take these new jobs is still uncertain.
So inflationary pressures on the up then?
For wages, yes. But not really a lot right now yet. Nothing worrying, but it is moving incrementally to that point, and economic policy is played in very slow increments. So it's like a big steamboat is the old metaphor. So even if it's moving to 3%, it gets, even when you try to turn it around, it's still going to go to 3.1, maybe 3.2%. That's the idea. And then we had a JOLTS report this morning, which showed still many more job openings than hirings. We have about 7.2 million unemployed according to the unemployment report, and we have 5.5 million job openings. So that's a wide separation.
Are we starting to see, certainly as far as Europe's concerned, one of the big issues for the likes of the ECB in particular is inflationary expectations, and one of the problems for them has been that they haven't really been rising for a long time. Are we seeing inflationary expectations rising in the States to kind of underpin the increase we've had in actual inflation so far?
No, and it's very surprising. It's that the inflation expectations are going down, which almost implies that workers do not expect to see higher wages themselves. It's quite a perplexing, confusing mix right now on inflation expectations. However, in business, there's one report from the Atlanta Fed that tracks inflation expectations among businesses, and those in a more understandable way are going higher. But right now, I guess the consumer is in such not the whole consumer. We have to understand that this is a percentage of the consumer market, maybe older consumers, certainly Republican consumers, and they are turning on the spigots when it comes to confidence. And maybe that extra confidence is actually reflected in a downgrade for inflation, because higher inflation in many people's minds traditionally is bad news. In our case here in this economic cycle, however, we need a little bit more inflation, and maybe wages will get it. Certainly if we have this huge job program, we have to find, the Trump administration wants to add 25 million jobs over 4 years. We have 150 million employed right now. Theoretically, we're at full employment. We have 5.5 million job, or whatever that is, 5.5 million job openings. They've been stayed open all year. These openings have been there for quite a long time. The hiring is lagging significantly. It's more in the 5 million range. This has been going on, actually, I think, for about 2 years. And what that means is that employers are having a hard time finding the people for it to fill the spots. So adding discouraged workers into this pool may not be the people that will qualify for these positions. So it's going to be quite an interesting time, and it's going to be quite an interesting time for the Federal Reserve also, because they have these inflation targets, and they would seem to be pretty modest right now. But I don't think policymakers are really facing up to the long term. They're, I think, hiding out right now in the short term, and that these programs have to unfold and they have to take effect. But and maybe their job security won't be so great if they look in the longer term perspective.
Yeah, that's interesting. I think it's the same sort of thing we're seeing over here. I mean, obviously, most of continental Europe, and indeed even the UK, or to a lesser extent, doesn't have the same kind of domestically generated growth that you do. So even though we are seeing improvements coming through in most of the labour market now, albeit nothing like as quickly as your side of the pond, it still seems the case that workers, typically speaking, are cautious about maintaining their jobs given all the various uncertainties we've talked about before, looking into 2017 and indeed into 2018. But I guess one reason perhaps being a little bit more optimistic for once, because I suppose I tend to be typically a bit pessimistic on Europe, is looking at some of the industrial production numbers. And I'll pick on them because it's a relatively quiet week for economic figures out of the Eurozone and indeed out of the UK this week. But we'll get the industrial production numbers for the UK tomorrow, and we'll get the Eurozone figures, their counterparts, on Thursday. And if there's something that's been missing, particularly as far as the Eurozone's concerned in terms of the economic recovery to date, it's been a very much the input from the manufacturing sector.
Well, now how has that sector? Now here, we're seeing advanced indications the last couple of months. Nothing really in the government data yet, but we're definitely seeing signs in the regional reports of strength. Are you seeing anything like that over there?
Well, that's it. We're starting to, and it's interesting, as you say. A lot of it really is materialising first in terms of the soft data, the PMI surveys and the like, and they've really been suggesting that industrial production ended 2016 on a pretty decent footing. We've seen the December manufacturing PMI for the Eurozone as a whole. That was up at, not in too interesting all the individual numbers, but almost 55. That was its highest reading we've had since April 2011, and all the national PMIs that go into the overall Eurozone index all moved up, including Greece, although Greece is still sub 50. But the bottom line is it means that on paper, Eurozone manufacturing in the fourth quarter of 2016 saw its best performance since the second quarter of 2011. Now, in the UK, we've had strong numbers here for manufacturing really over the last several months, at least a good deal stronger than expected by most people in this, this new uncertain Brexit world we're looking at the moment. So it does seem that at long last we'll begin to get the recovery in manufacturing, which I think has to be in place if we're going to see a sustainable overall economic recovery across Europe. So things are looking a little bit better now.
What about consumer spending during the holidays? What do you see over there?
Well, obviously we don't have the hard data through yet, but we've had some survey figures suggesting that in terms of the Black Friday, that was strong. Nothing to worry about there. Then we see a pause, and it looked as if the major department stores are getting a little bit worried. But some of the figures we've had out overnight our time have suggested the Christmas week itself was actually extremely good and indeed better than last year. So I think if you put it all together, it looks as if December was a pretty decent week, at least as far as the month, at least as far as the UK is concerned. For the continental Europe, is still lagging.
Now, we're going to have to wait a little bit to get your government data. Over here, the government data on retail sales will be out on Friday for December. And that's a bit earlier than in your case. Is that right, Jeremy?
Yeah, that's very much the case. Particularly UK is not quite so bad. But for example, as far as Eurozone November retail sales, we only got them out last week. So we got best part of a month or so to see what's going on there.
So we'll have a big indication here. Now, November here was not good at all. I mean, consumer confidence may be through the roof, but it did not equate into going into regular shops and buying things. However, auto sales, which are a little bit fuzzy, they came in unusually strong in December. Now, that could also, we'll have to find out to Friday if this was consumer buying. This could have been business buying. This could have also been discounting, which would affect the retail sales report. But it does look like consumers went out and bought cars in December. But whether or not the actual holiday shopping will, in any case, the bottom line is that the consumer right now is supporting GDP, fourth quarter GDP. It looks to be about the 2% annual growth range, somewhere, roughly there, which is pretty modest. But that's roughly where GDP is tracking, which is kind of what the long-term average has been. It would be down from 3.5% in the third quarter. So I'd say roughly, if I had to vote for GDP over here right now, I'd say 2% in the fourth quarter. What would your votes be for the UK and for continental?
I'd say for the Eurozone, we're looking probably something similar. I say at the moment it looks around about 2% or so, probably with a better contribution from the consumer sector in the fourth quarter than in the third quarter. For the UK, if anything, it looks as if it could be a little bit stronger than that. Unless we're going to see a setback for retail sales in December. As I mentioned, most of the anecdotal evidence has been pretty good. We're probably going to see UK growth at back end of last year, 2.5% to 3% type area. So
I'm
go.
sorry, Jerry. I have one question, and that's, I guess it probably should be our last question. And that's about Brexit. Now, you see all these news items. The PM will say something here, something there, and court rulings are going to be coming out. I mean, we don't know what the date is, but is there an equal risk that there will be a upward shock, no shock, or a downward shock, or which one of those three things, or is it no shock the greatest chance right now?
At the moment, it's one of total confusion, and I think that's starting to be reflected in what's going on with the pound. If people remember, towards the back end of last year, we saw sterling have an extremely good run, is making very strong headway against a strong dollar and against, albeit a weak euro. What we've seen during the first, 10 days or so trading of this year is that pounds hit 3-month lows against both those currencies, and that despite strong figures. And why? And it's really, as you touched upon just now, some comments coming out of the UK Prime Minister hinting that perhaps it could be more likely to be a hard Brexit than a soft Brexit. But now, of course, we got 10 Downing Street backtracking on that and trying to blame the media for overhyping this stuff because we don't know yet.
Is a hard exit necessarily economically bad or bad for the financial markets? It sounds bad.
Well, I think the biggest concern, certainly from the way UK financial markets have been trading since this whole issue came to the fore, is what happens to the City of London. I mean, London is worth, well, let's say somewhere around about 20 to 22% of total UK GDP. And London, of course, is services based. The worry is if we get the hard Brexit, we lose our access to the single European market, and in particular, access to the European financial market. And that is vital to London's prosperity, or at least it's perceived as being that. So hard Brexit, at the moment at least, equals a weak pound.
Okay.
So one last thing I'll say, if people are looking for trading opportunities before we just close this up, say the UK figures, economic numbers at the moment really are continuing to look very good indeed. The pound's down on the back of the hard Brexit worries. If we see some fresh stuff coming out on the news wires over the course of the next day or two, suggesting, well, look, perhaps it's going to be a soft Brexit rather than a hard Brexit, but all of a sudden the pound could be in for a very sharp rally. On which note, I guess that's probably pretty well it as far as myself and Mark are concerned today. So we'll wish everyone a happy trading period and look forward to chatting to you all again next week.